The only thing we should learn from history is that we don't learn from history. Every year there are forecasts of doom and gloom and property market Armageddon, and we don't learn that property values are very resilient. In today's Property Insider video, Dr. Andrew Wilson and I address those headlines that are in the media again saying interest rate rises could cut house values by 15%. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so you can be kept up to date. Interest rate rises could cut house prices by 15%, according to the RBA. Well, that was a headline run by the Australian Financial Review last week. But did our Reserve Bank really suggest that they would cause the value of your home and mine to plummet by 15%? Now, we know that the Reserve Bank kept interest rates at historic lows when it met last week. But following that meeting, the media and the usual commentators had a field day delivering headlines like earlier bigger rate rises could trigger sharper house price falls, because Dr. Philip Lowe and the board left out one word from its statement after making its interest rate decision. What was that word and what are the implications? That's what I discuss today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, in today's Property Insider video. Hi, Andrew.
G'day, Michael. And we really are working our way into a really silly environment regarding interest rate commentary. This is almost cloud cuckoo land stuff. The omission of the word, as you mentioned, the word is patient, that the Reserve Bank hadn't used that word in its statement regarding the direction of monetary policy the first time in a couple of months. And yet that set the dogs running, almost in their opinion, validating that we have an imminent interest rate increase. Beside the fact that the statement that was made by the governor was exactly the same, basically, as every other statement he's made recently, they don't have the data to suggest yet that inflation is out of control, that wages data is still subdued, and that they're waiting on the latest data. Well, of course they're waiting on the latest data. We all are. That's what determines monetary policy. But I think it just does reflect desperation of media to drum up fallacious headlines around house price falls and higher interest rates. But I think the banks really have taken a step higher in their desperation to talk up the prospect of higher interest rates. We know the banks are very low margins, that higher interest rates are needed from their perspective to increase their margins. And I think also it's interesting that we've seen fixed term rates rising over the last month or two. And I think perhaps that's another indication that if the banks are predicting significantly higher rates now, which just are completely illogical in my opinion, this year, that it may encourage more to actually lock in fixed term rates, to refinance at these higher rates compared to where they were last year. So we have an election coming up. Maybe the party should start thinking about the power of the big banks and whether they're really working towards the benefit of consumers. So how about that Labor Party and Liberal Party, the National Party and whatever party? Let's talk about what's going on in terms of this outrageous spruiking of higher rates, in my opinion.
Well, Andrew, most of the banks have locked in June as the time for the first interest rate rise. In fact, the National Australia Bank has flagged the first cash rate to occur in June at 15 basis points, followed by 0.25% interest rate rises in July, August and November, 4 interest rate rises this year. And the Sydney Morning Herald's telling us that sellers are rushing to put their houses on the market before rate rises occur and prices start to fall. But Andrew, aren't we just experiencing the typical pre-Easter rush of properties on the market?
Well, I guess, again, it reflects the level of credibility in some commentary that's made about housing markets. The big, the high numbers of auctions last weekend, Michael, and we'll discuss the results shortly, were of course just the typical Super Saturday of auctions we get the weekend before Easter. We've had this occurrence for years and years. It's a traditional surge in numbers, and it does reflect, in a sense, the end of the first part of the autumn selling season. But it's only because people are avoiding school holidays, Easter holidays, and the distractions. It's got nothing to do with people rushing in to sell because of a fear of lower prices, because a lot of these auctions, Michael, were booked in 6 or 8 weeks ago. So they're telling us what vendors were thinking months ago. And to be speculating that this is a rush to market from desperate to avoid some perceived downturn in the housing market, I think is clearly nonsense. It's just another pre-Easter Super Saturday. And in fact, the numbers coming in on Saturday, Michael, were a little lower than we've seen in recent years.
Well, interestingly, sellers are buyers. So What are they going to do? Are they trying to arbitrage and sell high, buy low? What if they can't? But Andrew, clearly there's something else in the pipeline as well. And an election has now been called. And it's an interesting month ahead for the property markets then, because there's the election, there's Easter, there's another long weekend coming up as well, the geopolitical uncertainties. What's all this going to do to our markets moving forward?
Well, it's always a little overstated. Again, we keep reminding, I guess, people who listen to our program here that there's a lot of hysteria in terms of headlines regarding the housing market. And really, people do take election campaigns in their stride in terms of what does happen in the housing market. Particularly, I think this year, our last national election campaign, of course, which was 3 years ago, we did have a focus on property. We'd just come out of the Royal Commission for the banking industry. There was some concern that there'd be some announcements in the policy in terms of the recommendations from that Royal Commission that had obviously added to some fears in the marketplace. And of course, we had the Labor Party promoting their policy to eliminate or reduce negative gearing for investors and the capital gains discount. And so there was a lot of, I guess, uncertainty regarding property in the last election. I don't think it had an impact on the housing market at that time. That was certainly starting to revive. And but this election campaign, Michael, it really doesn't have any property focus. And maybe in a way, the federal government's been spooked a little bit by all these predictions of higher interest rates in June, and they want to get in before there would be an interest rate rise perhaps in June, so they wouldn't have that sort of bad news. But I think they'll be pretty happy given the data that will come out towards the middle and end of May for GDP, for CPI, and of course, importantly for the wage index. I don't think we'll see the sort of extravagant results there that would tempt the Reserve Bank, who said that they need a longer period of higher results before they act. So I think that might be a good news story for the incumbent government, that the data doesn't support an interest rate increase. And of course, if we do look at some of the latest data, we can see some good news for consumers and motorists, with the price of petrol falling very sharply at the moment. And the international price of oil has actually also fallen quite sharply, and that the trend is down. So we know that oil prices, petrol prices were a significant contributor to the spike in inflation that we had over the December quarter, and that'll still work its way into the March quarter, because current petrol prices, of course, are for the June quarter. But the Reserve Bank going forward would be comfortable seeing that the price of oil is now starting to fall. So that means that those issues that pushed the price up perhaps are dissipating, and that'll work its way into inflation over coming quarters.
Now, we've spoken a couple of times about the pre-Easter Super Saturday that we experienced over the weekend. How did the auction results pan out?
Well, as usual, it's the law of supply and demand, Michael. More supply puts downward pressure on, or certainly the results, and demand has been easing, particularly in Melbourne and Sydney. If we look at clearance rates as an indicator of that, clearance rates have fallen from 80 plus earlier in the year into the 70s, and now into the 60s. Clearance rates held up on the weekend in Melbourne and Sydney. They were around about where they were the weekend before. There was over 1,200 auctions in Sydney. That was the highest number for the year so far. Again, that's what we always see on the Easter Super Saturday. And Melbourne had 1,500 auctions and still had a clearance rate just under 70%. Now, lower than the weekend before, but I think that given these high numbers of auctions, that's quite a steady result, and still very much a seller's market, in my opinion, Michael, although certainly the balance of power has been shifting now over the past month, but still pushing towards 70% is, you would suggest, is a seller's market. But the market's absorbed high numbers of auctions, the highest for the year so far, without any significant decline in the clearance rate. And if we look at the smaller markets, we had Brisbane bouncing back with a big clearance rate of 80%, again with high auction numbers. And that's Brisbane's highest result for some time. Of course, the Brisbane market, and by that I mean the last month, has been affected by the floods. And Adelaide and Canberra also produced quite strong results, although Canberra was down a bit on the weekend before. But there were high numbers of auctions there again in that market, reflecting that Super Saturday environment. If the market had have been really engaging in a significant backtracking, I would have thought that given all those auctions, we would have had a lower clearance rate, but it really held it. The market held its own very much on Super Saturday.
Well, our sense on the ground is buyers are still out there. They're still keen. The FOMO has left the market, so they're making considered decisions. They're not taking shortcuts, but they're still very serious about getting in the property market, Andrew.
Yeah, that's right. And we've had all those interruptions over really going back to 2017 that have now worked their way through the system, particularly in Melbourne and Sydney. COVID, of course, affordability has peaked, which means that people are still buying and selling, making decisions to change their residences. But what we'll see is still turnover and volume. But we're not going to see the prices growth that we've had because affordability is constraining the capacity to bid up properties as we've had. But we're just normalising our markets really, Michael. And I think this is a really good thing going forward. And I guess we're waiting anxiously to see what happens with interest rates.
Okay, well, the Reserve Bank will be making its next announcement in around 3 weeks' time, and that will lead to another round of speculation. But we'll be back next week, even though there'll be a few interruptions with Easter, but we'll see what's happening in the property markets. Look forward to catching up with you then, Andrew.
Yes, and one final thing, Michael. It'll be very interesting to read the full minutes of the Reserve Bank's meeting and to see how the advocates for higher rates spin that one, because they've really spun the statement, the Reserve Bank governor's statement, with the lack of that one word. It's just really bizarro.
We'll see if that word's included in the full statement. We'll discuss that next week. Thanks, Andrew.
Thank you, Michael.